Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the hidden divergence, a powerful yet often overlooked concept in Forex trading. Hidden divergence can help you identify trend continuation opportunities with precision, giving you an edge in the market. Stay tuned until the end of this video, as we will not only explain what hidden divergence is, but also show you a step-by-step process on how to trade with it effectively. Let's get started. What is a hidden divergence? Hidden divergence is a trading concept that occurs when price action of an asset is not synchronized with a technical indicator, suggesting a continuation of the current trend rather than a reversal. This can be a valuable signal for traders looking to capitalize on ongoing market movement. There are two types of hidden divergence. One is called the bullish hidden divergence, which happens when price make a higher low. When price make a higher low, but the indicator shows a lower low. The indicator we'll be using for these studies will be the RSI. When price make a higher low for the bullish hidden divergence, price make a higher low. Let me remove this volume. Price make a higher low while our indicator makes a lower low. This is a divergence, and it suggests that the uptrend is likely to continue. Now, in case the second one is the bearish hidden divergence, and this occurs when price creates a lower low. From this area, we can see price creates a lower low. Price creates a lower low from this point, while our indicator is creating from this point is creating a higher, in fact from this point is creating a higher, let me get that straight. Price from this point is creating a higher high, as you can see, or a higher low. As you can see, price is creating a higher high from this area, but from price is creating a lower low. Why does this matter? Understanding hidden divergence is crucial because it often provides more reliable signals for trend continuation than rather divergence. It can give you early warning signal for potential trade entries, helping you make informed trading decisions. Additionally, hidden divergence work effectively across multiple time frames, making it a versatile tool in your trading strategy. By mastering this concept, you can enhance your ability to identify and follow prevailing market trends with greater confidence. Now let's break down this strategy effectively. So the effective trading of hidden divergence involve a structured approach to the entry and risk management. Here is how we can incorporate this element into our strategy. The first of all, we would have to identify the hidden divergence. We would begin by identifying the hidden divergence on our chart. This involves comparing price action with an oscillator such as the RSI or we can also use the MACD. Now for the bullish hidden divergence, we will look for a higher low when the oscillator shows a lower low, while in case of a bearish situation, we will look for a lower high. While the oscillator makes a higher high. Now the second step is to make our entries. Once you have identified the hidden divergence, it is crucial to time your entries effectively. The first way to time your entries is by the confirmation. Wait for confirmation of the divergence through additional indicators or candlestick pattern. We can use candlestick pattern when we notice our divergence. We can use candlestick pattern like your bullish engulfing, or you can use your morning star candlestick pattern to show that yes, you can continue in that direction. We can also use our entry point to enter the trade when both the price action and the oscillator indicator confirm the hidden divergence in the same direction. So the moment you confirm this hidden divergence in the same direction, you can enter your trade. Maybe after price has shown your candlestick pattern, you enter your trade. Let's not forget risk management. Proper risk management is essential to protect your capital and ensure long-term success. You have to place your stop loss orders just below the recent swing low for a bullish trade, or above for a bearish trade. Like we did here, we put our stop loss just below. Now let's not forget our position sizing. We have to use appropriate position sizing to limit risk per trade. We have to limit our risk per trade. So typically, risking no more than 1 to 2% of your trading account on a single trade. So you do not have to risk more than 1 to 2% of your trading account. Now, how do we set our take profit? We set our take profit based on key support areas, key support or resistance areas. Like you can see, this area is a previous high, and the previous high is a key support area. All these areas that price has been reacting from, this place was the previous resistance, support, resistance. We can put our take profit in that area. Those are places that we can use, or we can make use of a trailing stop to lock in profit as the trade continues to move in our favor. Then we also have to consider our time frame. Hidden divergence can be applied across various time frames, but it's important to align your time frame for signals and for better accuracy. Use higher time frame for the trend direction, and use lower time frame for a precise entry. Then we have to confirm our signals on the multiple time frame to strengthen our trading decision. So whatever we do, we have to make sure that the higher time frame is giving us the trend direction. Then we can confirm our trade by using the lower time frame as an entry point. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe, and turn on the notification bell so that you will never miss out on any trading tips and strategy. Thank you for watching, and I will see you in the next video.